The RSI indicator. In this video you will learn what the RSI is, how to find potential market turning points in the market, how to use the RSI and what the different levels represent, how to gauge an overbought and oversold market environment, how to use the RSI for exiting trades, how to change the settings and what the effects are. The Relative Strength Index, or RSI for short, is an oscillating indicator that shows when the market may be overbought or oversold. It appears below your price chart and is made up of a single line that moves between the levels of 0 and 100. 0 being the extreme of the oversold range and 100 being the extreme of the overbought range. The indicator can help traders assess current price action to find potential market turning points. It does this by determining when a current trend may be slowing or potentially coming to an end. There are essentially three levels that traders pay close attention to when using the RSI: the overbought, oversold, and mid-level. When the RSI line moves up through the mid-level or 50 level, it indicates that there are more buyers in the market, causing price to rally. And if the RSI line moves down below 50 or mid-level, it shows that there are more sellers in the market, causing price to drop. When looking to trade using the RSI, you want to pay close attention to the 30 and 70 level, as these are what the majority of traders monitor. The market is said to be oversold when levels of 30 or below are reached, and overbought when levels of 70 or more are reached. In this example, you can see when the RSI moves above the 70 level, the uptrend pauses and eventually starts to turn down. In this example, you can see when the RSI moves below the 30 level, the downtrend pauses and eventually starts to turn up. You can use the RSI indicator to help confirm your entry into the market by waiting for it to move into the oversold or overbought level. This normally happens after an asset has made a substantial price move in one direction. Remember to assess the market environment, as some trades will be with the trend and others will be against the trend, which can be lower probability. Another useful way traders use the RSI is to confirm exits when already in the market. For example, if you were long and price was heading up strongly and the RSI was giving an overbought reading above 70, you may want to exit or reduce your position size. Most trading platforms will allow you to change the indicator settings of your RSI indicator. You have the choice of either making the indicator more or less sensitive to changes in price. The default setting for the RSI indicator on MetaTrader 4 is set to 14 periods. If you wanted to make the indicator less sensitive, you would increase the setting value. This would result in the indicator moving into overbought and oversold level less frequently, giving fewer trading signals. In this example, the RSI setting has changed to 28 periods. Notice how infrequently the line moves into the 30 and 70 levels. If you wanted to make the indicator more sensitive, you would look to decrease the setting value. This would result in the indicator moving into overbought and oversold levels more frequently, giving regular trading signals. However, this will lead to more false signals. It is important to note that most traders do not change the settings, keeping them at the default of 14 periods. This provides them with a reliable indicator for most market conditions. In this example, the RSI setting was changed to 7 periods. Notice how frequently the line moves in between the 30 and 70 levels. So far, you have learned that the RSI indicator is an oscillator that shows when the market may be overbought or oversold. You can use the RSI to time entries and exits from the market. Traders can change the settings to make the indicator more or less sensitive to price movement.